All right. So we're tuning back in on the RILA conversation. So last week we kind of reintroduced the topic again of product training. So to kind of kick things off here, I wanted to hear from you guys of like what maybe you learned new from last week's training, what you're still maybe stuck on, or what you might have maybe some better insight on when it comes to RILAs.
Well, I'll start because I probably have the least amount of knowledge base, so I probably had the most to pick up. Um, I mean, I've for a long time. I mean, I've understood the general aspect of obviously what these products do, but it was really just eye-opening to look at because there's been conversations in the past about the no fee kind of being like a smoke and mirror sales pitch kind of deal, but when you tie it all together with obviously the interest rate market and why it makes more sense probably for some clients nowadays, with interest rates coming down and there not being that big difference in the par rates and stuff. I actually had a conversation about the no fee twice on Friday, and I mean I've just never had that conversation before. It's just kind of a hey, this is a potential thing that we can pivot to, and like I got a current client that's got this. I was telling Alec yesterday, he's got like an 8 month CD tied up at the bank, Um, but that's on the calendar to follow up with, and when that comes time to almost mature, and he was intrigued about the possibility of doing something like that. So that's one takeaway that I had, which I appreciate.
Okay. So okay, Ryan, do you have something?
So I think I learned the one strategy that you highlighted within Allianz's platform with the trigger rate. If I understood correctly, I've not used that particular strategy in any of my accounts, but it sounds like even if the performance is negative, but within the parameter, there's still a positive credit to that setup. Is that how I understood it?
Correct. Yeah. So if it's got a 10% buffer, if the market is down 9.9%, then not only will they not be losing, but they'll also then get the trigger rate. So if it's a 10% buffer and the cap is then 10, I think it's like 10.8 right now, the market can go down 9.9 and they will actually get credited 10.8 positive. So it
Okay,
gives you a whole lot of flexibility.
good. Okay.
So do you feel like is there anything that's still kind of confusing when it comes to, how all of these credits work, maybe the rate sheet proposal or like the illustrations, income, any of those things kind of confuse you guys still or need more clarification?
I would actually want to it's not that I don't understand it. It's my wanting is to understand a um with the performance lock specifically for Allianz, since we can do the lock and go, and they're, they got kind of the monopoly on that feature. My clarification or desire is to understand, what if you don't do that? And so what's the primary benefit to doing it versus not doing it?
Okay, so you've got a client. Why should we do a rate lock versus
Hmm.
not? Okay.
Yeah.
So, yeah, that's a good question. Joe, do you have anything that you would want to maybe uncover a little bit?
No, not really. I mean, I think that's a good question. So let's dive into that.
Okay. So I think, Tyson, correct me if I might be thinking wrong. What I'd like to do is maybe bring up a live client account
Yeah.
and just show what those options are. So while I'm doing that, I'll kind of walk through things. So when we're evaluating, so we have the ability to do this lock and go again. It's evolved here over time. It used to be, I think, like 3 times a year, and now it's 12 times a year that you can do a lock and then jump right back into the market. The value here is a couple of things. So the first and biggest is being able to call a client and be able to tell them, hey, your account is up and we're going to capture those gains in your account. And simply put, that's where I tell my client in layman's terms, we're just gathering what's already there. Your account is up. I'm just calling you with good news. So that's obviously kind of a very surface level thing. But when it comes to locking and jumping back in, before we look at what the new rates are, the biggest benefit when you're doing so is increasing the buffer from a dollar perspective on your contract. So if we put $100,000 in and it's a 10% buffer, the buffer from a dollar standpoint is $10,000. If we then take a 15% increase in the account, so it goes from 100,000 to 115,000. If we lock in those gains and jump right back in, a 10% buffer is now 11,500. And the benefit of doing that a couple times as time progresses, what you're able to reflect and show a client is that buffer dollar amounts eventually will get over and above what you initially put in. So let's just say we get it a couple times, lock and go again a couple times. You're able to then show a client, hey, you now have a base contract of let's just say 130,000, and so we have now a buffer of 13,000. Keeping it, I don't know if my math is going to end up being correct, but the point in showing to the client is, hey, if we take a 10% loss, we would actually, even if we took a fractional loss, we would actually still be net positive in your overall contract. So we're going to still be ahead in your contract than if we didn't go about this, that way. So a confusing way to explain, we're essentially building net returns in your account from the protection of loss. So we're going to continuously be ahead in your contract. I'm getting an account pulled up. Tyson, do you have a better way of explaining that, or
Um, I don't know if I'll label it a better way, but I have a different way.
okay?
First of all, did you guys follow that at all? Does that make sense to you guys?
It does. Yeah.
So the easiest way for you to think about it, which is also the easiest way for you to explain it to a client, it's worked very well for me numerous times, is every client understands homeowners insurance. So I just go, so if I have a $400,000 account, I use a $400,000 house, $100,000 account, $100,000 house. Okay, just to make it on par. So let's say a client's got $400,000. I'll be like, okay, so let's imagine you have a $400,000 house and we have insurance on this in case the value of this house goes down in terms of a calamity. A calamity would be a decline in the stock market, right? So we have this 10% buffer, which means we have to lose more than 10% in order for you to experience any loss. Everybody kind of follows to that point. But let's just say we have a great year in the market, and I'll use really round numbers just to make it simple. I'll just say, hey, let's say your account grows from 400,000 to 500,000. Well, your buffer is protecting any kind of loss below 400,000. So if we don't raise the buffer to protect that growth, we're not insuring that capital that you've increased. So it's kind of like if you have a $400,000 house and over a period of time it grows in value to 500,000, but you never update your insurance or your insurance had no like increase rider on or anything like that, and then your house burns down, well, you've lost a $500,000 asset, but you're only getting a check for 400,000. So we need to increase the insurance to protect the value of the increased asset. And that really clicks with people because they can kind of like conceptualize that and understand it. And then they understand the idea of, yeah, we keep raising the buffer every time we have gains. And that's the whole value of this product. Because if you never do that, if the market goes up to, if the account grows up to 500,000 and then it drops all the way from 500 down to 430, which is very normal, right? Your client's going to experience all that up, all that down, and have no benefit from the buffer whatsoever. So if we don't raise the buffer, the whole game in you guys, what everybody thinks the game in RILAs are is rates. who's got the best rates, who's got the most fanciest dual direction, all that stuff. That's what everybody thinks the game is. The entire game of RILAs is your ability to increase the buffer and protect gains as you go.
That's helpful. Yeah. Yeah. So I guess paralleling it with like a managed account and how the how a decrease to their account value differs. I mean, they're
Well, in a managed account, you have no buffer, right?
right.
So now we're going down a tangent. So Alec can pull this up in a minute, but now we're going down a tangent of pros and cons.
Mhm.
A managed account's going to fluctuate more. Um, but we're comparing an apple and an orange now because a managed account can be diversified more and have different asset classes. But a big distinction is a managed account is going to earn dividends over time, which,
Mhm.
that's capital additions to the account. So, you know, the maybe as Alex pulling this up, maybe one big takeaway for you guys, in my opinion, I should preface it with that. You should only use a RILA for one of two reasons, period. Number one, your client otherwise wouldn't invest in a primarily stock-oriented portfolio from a risk management standpoint. Or number two, you need to create some sort of rider income stream over time.
Mhm.
It can make a third point, but it'd be a much more distant third, which would be you have a large chunk of money you need to get tax deferral on. But I want to stress that's a distant third. The two biggies are the risk management element of it and the income rider. And I won't I want to say something here. I don't want to get into the whole story because I just don't want to hijack the meeting. But I got into a little bit of a debate with another financial advisor in town over a mutual client or the client he was trying to take from me. And basically, he was criticizing an annuity that I had sold this client years ago, basically saying, I don't think this client needs an annuity. They've got enough capital without a guaranteed rider, all that kind of stuff. And my whole point, I didn't really get all this out. It wasn't really relevant, but I'm like, you could argue the client no longer needs the amount of money into the annuity he has, but this particular client would have never been more than like a 60/40 portfolio guy, and he would have panicked a couple of times in market declines. But because I had a guaranteed lock-in feature on that annuity, now this was a traditional variable annuity with a rider where it locks in and the rider base withdrawals. But the point is like the kind of protection of the annuity gave the client the emotional comfortability to invest, and I've had them 90% in stocks for the last like 6 or 7 years.
Mhm.
So even with higher fees and all that, he's way farther ahead because it allowed me to allocate him more aggressively than I otherwise could. So maybe to tie this all together, if I have a $500,000 chunk of money and 10 years to grow it, if I put all of it into a RILA and I put all of it into an aggressively managed account, my aggressive model, I'd bet everything that the managed account will be worth more money in 10 years. Now there's a probability that I'm wrong, right? It could be on timing of market declines, but generally speaking, a managed account's going to do better over time because you're earning dividends and you're not subject to all the gimmicks of an insurance product. Hey, this looked great when we started it, but now the renewal rates really dropped, or they changed this, or we got whatever it is, right? Um, but where this whole game gets more interesting is that's assuming the client's willing to invest. Like, so I don't invest any of my money in a RILA because I don't really get phased by these 20-30% market drops. But for a client that otherwise would, a RILA can be if the conversation changes of a RILA compared to like a 60 or 70% stock, 30% bond portfolio, well, I take the RILA all day in that battle. Does that make sense? Are you guys following that?
Yeah.
Joe?
Do you want me to say yes instead of nodding?
Yeah, that looked like a very like tentative nod.
No, I mean, I get it. Sure.
Okay, cool.
I think one thing that, if we can touch base on, I don't know if you're planning on it, Alec, or not, is those getting into those renewal rates and how those, I don't know if that was something you were going to talk about today or not.
We can. Yeah, we can
I
we
don't
can
want to, I don't want to take the train off the track, so whatever.
Yeah, well, yeah, we can jump back on the tracks here. So, I appreciated what how Tyson explained the lock and go again, similar to like a house. So that makes it a lot more conceptually understanding for a client. I did this with a handful of clients. I think it was 2 weeks ago now, and I just pretty much said, "Hey, I'm calling you with good news, and if you want better news, we can make a couple tweaks without making any material changes to your account." And so they just kind of had said, "Yep, if that makes obvious sense, let's do it." Because when I had tried to explain it, I got kind of lost in probably the science of it as opposed to the art of describing it. So um, from here, Tyson, I need to be able to share my
Oh,
screen.
sorry. All right, you should be good.
Um, are you guys seeing now my Allianz account? Yeah, okay.
Yep.
So when it comes to then making a consideration to lock and go again, I'd say there's a couple layers. The first is if the contract is up, to whatever degree it is, you have that discretion. So with Allianz, we can do it 12 times a year. So you can see you have 12 opportunities. I have for this client, I have 11 opportunities remaining. So this is one of the ones I did 2 weeks ago. So there's not going to be a current radical change in his account. However, when we're looking at it, I like that this is on the home screen. So you're flipping through, you can see when you started the account and all that, and it just
Yeah.
shows right here a huge box, lock and get back in, and it'll show the reallocation rates. So we can jump into here and see what the rates are of if we were to lock and jump back in, what are they? Something to notate is there's going to be a short time frame of what it looks like to do it at 2 months. So these rates are going to always update the first Tuesday of every month. So I think it's like the last week of that month time frame. So I think that would be next week. Next week, you'll be able to see current and then next month. But if we're just looking at this client account, I have him just allocated to the 6-year S&P 500 index with a 10% buffer. He's not going to be retiring for a certain time frame. And he said, let's just defer this and have this thing grow as big as it can. I'm not really looking at it. So what can we do to just maximize returns? So for that standpoint, I was just looking at what the par rate was, and then what we can jump in. So I'm like, hey, we can just keep it simple, and we'll have an uncapped strategy with 120% participation rate. But in this case, we threw $100,000 on the dot into this account. And so when I called him 2 weeks ago, I was able to help him get a 24% increase locked in. We started this May 8th of last year. So in about a 7 month time frame, we were able to grow by 24% and lock that in. But when I was considering do we do it or not, I looked at these early reallocation rates. So what I'm looking at is can we continue or get close to what we've presently been doing with the ability to also consider, you know, a considerable up market. So for him, I was able to jump right back in the same strategy with the same par rate. It was 120 uncapped. So I felt good about that. But let's say 3 months from now, he's up another 7%. And in this case, let's just say rates have changed radically. And now all of a sudden, this participation rate is 100%. And maybe let's just say it's even in a worse scenario. Now, instead of being uncapped, it has maybe a cap of 200%. So it's just radically gone down to the point where I would then maybe consider do we or do we not do it? At the very minimum, I think the client wins by locking in the gains. But from there, is it then advantageous to continue with the same strategy or mix some things up? Or is it at the very minimum, are we going to be able to continue moving forward with, kind of some type of a growth strategy? But it's all going to change month by month. So some of these, a month from now, this par rate might be 115, it might be 125. And then you can see these 1 year strategies, those are going to fluctuate too. So whatever your client is invested into, I think it's valuable to recognize that we can lock in something, but then it's based on what Allianz is going to offer for that current month. Does it match or come close to what the client's invested into to make sense or make a complete change reallocation wise?
And so just to reemphasize with this 6 year bucket and a 10% buffer, I mean, I think they've back tested this. I don't know if they have like literature on it, but I mean, the odds of the market being down more than 10% over a 6 year period is like very slim. Is that the understanding?
Yeah, I want to say it's at like, 99 point something percent of the time. I think if I'm not mistaken, when they back test it, there's like one, if not maybe two time frames where
Hmm.
there's a 6 year period where it has gone down. And in fact, if I remember correctly, when Tyson and I said it on a meeting, I think that was last Monday, we actually hit that where over a 6 year time frame it was down 10.02%. And so we actually showed the client, hey, in this case, we did just come across that buffer. So you would have taken a 0.02% loss in that 6 year time frame, but it's like one, maybe two 6 year time periods.
So here's a question for you guys. I think we're clear on the upside of this. Let's stick on the 6 year, 120% par rate, 10% buffer. So we're pretty clear on the upside. If we're in a long-term bull market, this thing's going to do pretty well, right?
Hmm.
And if it's technically true what you just said, Ryan, that 99% of the time the market's going to be positive over 6 years, the question becomes, what could go wrong with this in real life?
I mean, I think the only thing that could go wrong with it is if the opportunity cost behind not doing a managed account if it's a bull market for a
Ah,
long time.
that's actually a very sophisticated answer, Joe. Not what I was going for, but correct. I mean, let's put that aside. That's correct. But just within the confines of this product, in other words, like what are we missing here? I'll give you the answer, and this is going to catch a lot of advisors off guard when it happens. The thing about the 6 year with only either 10 or 20% buffer, but specifically with the 10, is that is not going to offer you a lot of protection years one, two, or three. Okay. Because the way these things track is when you have that 10% buffer, every carrier does it slightly different. Jackson actually applies the buffer month by month, and you'll see it on their website. Like they'll whatever 6 times 12 is, what is that, 72 months? So whatever 10% divided by 72 is, like they're gonna apply like a 0.17% buffer every month. Okay. But it helps us conceptually understand it. If the market goes down 15% in the first 12 months, your client's going to think, God, no big deal. I've got a 10% buffer. But in reality, if they log in and open up their account, if the S&P's down 15, they're probably down 14 and a half or 15 on an interim basis. Does that make sense?
Yeah.
So this is going to track very much like an index fund on an interim basis. So what we love about this product on the upside is its liability on the downside. If we love the fact that, hey, the S&P's up 12 and you're up 13 and a half. I mean, it's a fun business to be in, to like click a blue button and lock in gains and call your client. But just understand the opposite of that same coin is if the market's down 10, you're going to be down right with the market in that. So to make something up on a 10% buffer, if the market's down 15%, I bet you're down close to 15% year one. And a 20% buffer, you're probably down 13 and a half or 14. You're gonna have a little bit more protection. But that's the risk of the 6 year. So just like I say in a managed account, I'll take any size bet you want to offer me that over, we'll use a 6 year time period here. An aggressive portfolio is going to beat a moderate portfolio over 6 years. But there's going to be some periods of time where the moderate beats the aggressive, right? You guys understand that?
Mhm.
So I can't, by that same methodology, I can't put my client into a strategy that they're not going to be able to stay in. So that's why the middle class doesn't make money in stocks, is because they don't have the discipline or education to stay in certain funds. They're either too fearful, and so they sell at the wrong times and don't get back in and keep too much in cash and all that stuff, or they're too greedy and they're constantly skating to where they think the puck is at because they watch too much CNBC. And so they're like, oh, well, I got to buy energy stocks. I got to get into gold now. I got to, they're all over the place. So if you just stay the course, you're going to make, it's almost a slam dunk. You're going to make money. It's crazy that nobody actually does that, or the vast majority of people don't. Well, it's the same thing here. I got to be careful that I can't put a client that otherwise couldn't tolerate a 25% drop in their portfolio in a 6 year strategy. Or at most, I might do like 20% of their overall count in the 6 year and then later in some 1 and 3 year strategies or some dual direction. I've done a lot of that for my more moderate clients, so that we're not facing these big drops.
Just to clarify, so this does it the same way that the Jackson does that you were talking about. So that 10% is not like right off the rip.
Absolutely. It's not exactly the same as Jackson does it, but it's substantially similar.
Huh.
So I guess maybe for like my perspective, I'm understanding this a little bit better of how that works because like when we've talked about this in the past, I'm like, well, it's a 6 year strategy. So if we stay in and we go back positive again, then who cares? But I guess
That's correct. But I mean, I could pull up a stock market chart, but just follow with me. If the market goes like up and then way down and then back up and we're end up at a high point, it's an unemotional, desensitized thing to look at that and be like, oh, well, we got all that money back, no big deal. But you guys, some of you that have been around long enough know when the market's cascading down, and every channel and every YouTube commentator is all over about like, man, if you're in stocks, you're an idiot. You got to sell. This time's different. Trump's going crazy. All this stuff, right? You think the world's coming to an end. It's a lot harder to stay the course emotionally. And that only compounds as you have more and more money at work and you're closer and closer to retirement. People freak out. So that's why you got to be careful that you're properly allocating clients using this product, because those 6 year indexes are going to experience some significant volatility. Remember, when you guys hear the word volatility, you're primarily I'm willing to bet your mental connotation is like negative, but volatility is not negative or positive. It's just a rate of change. So volatility works both ways. We love volatility when it's positive, right? But volatility is what takes people out of the game. So you gotta keep people allocated with what you think they can handle, and that's really our job. Our job is to keep clients as aggressively positioned as possible that they can live with. I'll give you a real world example. Because I had a client in last week. He had 300 grand of excess cash, and we put it in at maybe the worst time possible in recent memory. We went in like late 2021, and I put him half in U.S. strategic growth on Goldman and half in, if it wasn't aggressive, it was high series moderate aggressive. And for 3 months in, his 300,000 was like 320 or something to make it up. 1 year in, his 300,000 was like 200,000. And the whole conversation was like, hey, we can do better than a bank because banks are paying almost nothing. Blah, blah, blah. And no, it's a great client long term. But I told him specifically. Now he had this wasn't all his money in the bank. He had another he we kept a few hundred grand in money market because I said there's only one way this can backfire. And I did not I wasn't forecasting the huge market drop in 2022 at all. But I would say this in any market environment. I said this US strategic growth will make you the most money over time. But it's going to also be the most volatile. So the only question becomes is are you going to be forced to sell at a low price because you need this cash? And if that's the case, in this particular client emotionally, he's not the kind of guy that would freak out and call me to sell. It would be more that, hey, I need that money for XYZ. So I said, we shouldn't put $1 into this growth strategy that you think reasonably you might need in the next 5 years. Because as long as you're basically telling me you don't, it's always there if you need it. It's liquid, it's all that. But if you reasonably don't think you're going to need it, and we can ride out these dips, you're going to come out ahead. Well, we did a review yesterday, and that account round numbers has like $430,000 in it now. So he's way farther ahead than had he just plugged in a money market 4 years ago, 5 years ago, and let it roll it. But what a roller coaster ride it's been to get there. So I properly positioned the client on setting expectations. I properly allocated him. Um, in fact, I actually called him. I do remember this. I called him late 2022 and tried to get him to put more in because I'm like, I'm telling you, like, if you really want to like win, like you buying at 25% discount, you're gonna think I'm Warren Buffett in about 2 years, and he wasn't willing to do it. And I mean, he would have slayed it had he done it, but so be it. The point is, that's our business, guys. It's properly allocating clients to what they can handle, and it's knowing the risk going into something. And so, but that same story could have been true. I wouldn't have put cash into a RILA, but if you can follow that metaphor, had I put him in a 6 year index 3 months before 2022, man, that thing would drop like a stone. And and so you want to be careful that you don't have a client thinking, "Oh, I'm protected, I'm good." And turns out, well, I didn't realize I could lose 20% in this or 25% in this. Why did we do this in the first place? That's what we want to avoid.
So I guess maybe for my personal business, this helps me maybe shape things a little bit more when I'm sitting down with folks of why you take an approach of blending in more 1 year strategies to the account because it'll help on the obviously we'll capture 1 year market returns, but more than anything, it's probably protecting the downside
You
in it.
got it. The 1 year strategy is all about that buffer. So I've got a client I just set up a new Allianz Index Advantage with income. And without getting into the intricacies of how to manage that rider, which could be a whole separate training, he's basically an income, if not this year, next year. Like income, we're going to start income either year one or year two, right? Or let's just say take withdrawals from the account. So I have him entirely in 1 year strategies. Half of the portfolio is in performance strategies to pick up, 12, 13, 14% upside caps. The other half is in dual direction. And if you kind of net it all out, like in some of the dual directions, like 20 and 30% buffers. So I've essentially created almost a guaranteed rate of return environment. The only way this could like backfire would be if the market loses more than 25% in the next 12 months. And even then, it would only lose by the amount over that. So, I mean, there's just no way this thing's going to implode, right?
Mhm.
In a dramatically, unbelievably, I mean, Trump goes completely nuts before the midterms. And, we go down 35 or 40%. This client's down, 15. So it's like, what I'm saying? And that's like an extreme scenario. Like Trump hits the nuclear button and, loses the nuclear football. Who knows what's going on? I mean, it's guys, buckle up. It's going to be crazy. He wants to take over Greenland. Like, buckle up. So the idea is that's not, that client's, that wouldn't work well for a growth oriented client, but for an income right away client, like it's a great design. And so I would argue that's why we make all the money we do, guys. It's designing these products client by client. There's a reason why you can't just buy this stuff on the internet. Like it's the same reason you can't buy a whole lot of prescriptions directly. You need a medical professional that understands the risk of this prescription. What are the downsides? What are the side effects? What are the conditions that would make you not eligible for this medication? Because if we don't screen the patient before we apply the medicine, we could have some pretty disastrous outcomes.
So I like what you said there. Just the criteria going into this strategy is someone otherwise not willing to stomach that risk appetite of a fully, stock exposed managed account or an income play.
Yeah, I was trying to process, say that one more time, Ryan.
So someone who otherwise wouldn't be willing to accept the risk of a mostly stock-based account, or someone who needs that safety net of, 20 to 30% buffers with the intent
Yeah.
to make income off of it.
Yeah, I agree with that. And in fact, you know, if you think about it, like annuities are a spectrum, right? You have everything from like fixed annuities, pure fixed annuities on the very most conservative that look kind of like CDs with slightly higher rates for a longer commitment. And then you got your fixed indexed annuities, and then you got your RILAs, and then you got your variable annuities. That would be the whole spectrum right there, right?
Mhm.
Of conservative, greater risk, greater potential, but some form of protection across that whole spectrum. I think your job is so. I just feel like a RILA is so much superior than an index annuity. Um, there could be one minor exception. If you have I had a client about a year ago that just they have a certain chunk of money. It was something like 300 or 400 grand. I don't remember. And I had been managing it for a while, but they basically needed to turn it into an income now situation. And absolutely zero appetite for risk. Basically, just at this stage, we're like Tyson, we don't want to lose a penny. We need to know exactly what we're going to have. Period. Condensing a longer conversation. That's where we were. So I was like, okay. So I called AMS, ran a bunch of stuff, figured out the very best immediate index. If I remember, it wasn't me. I think it was income in like 3 years or something. But basically, they had something that was like, I mean, as an investment, it's going to do absolutely terrible. But it had like some minimum guaranteed like 7 or 8% like roll up each of the next 3 or 4 or 5 years, right? And so I could look at the client, I can say, here to the dollar, this is what you're going to get direct deposit every month in your checking account starting in 3 years. Fantastic. They were thrilled, right? So there's going to be some use cases here or there where
Mhm.
you want to take zero all risk out of the equation. And and by the way, like the RILA could have done better, but only if the market does well. If the market was flat or like up a year, down a year, up year, it would not have been where this is going to go. So outside of something like that, I just think a securities-based product is going to be far better over time because it's just going to do better than a fixed product with caps and limitations and interest rate sensitivity and long surrender periods and all that stuff. So, um, yeah,
I just remember from my latest securities exam, like the investment objective that trumped everything else is when does the client need the money?
you got it. The whole ball of wax. Yeah, I mean, I would argue I mean, you guys are all younger than me. I mean, if I were you guys, I would keep personally, I would keep the cash you need to have as an emergency fund and bank accounts and money markets and things like that. Outside of that, I wouldn't own a single because I don't own a single bond in my life. I don't have 10 cents in a bond. Like, what's the point? I'm going to fundamentally that's going to do worse than everything else I own over time. I don't need to exchange because I don't have any money. I also don't have a single penny invested. that I might realistically need in the next 3 years. Period. So like, and that's one of the reasons I'm so I don't love when the market goes down 25%. Like I'm like, all right, like, but like it doesn't deviate me off my strategy.
Mhm.
And so I know myself and what I'm comfortable with. And you get to, you follow those parameters. And I did the same thing with my client with the 300 grand. I said, hey, like, because he left a few hundred grand in the bank that was earning 2% or whatever it was. And that would have been the first money he dipped into had he needed it. Turns out he didn't need that either. But that's why he wasn't thrilled that the market dropped like it did, but we planned for that in advance. And that's just good risk management and asset allocation. But I think we've, as a team, I certainly know my book better than your guys' books. But as a general rule, I've had my clients more exposed to equities than most advisors would, or they certainly would have been on their own. And they have won massively because of that. And I feel amazing about that. I feel like that's been one of my core value adds to people, that gets me away from, am I really helping people here? Are we really making a difference? Or are we just kind of selling products? I think I felt that way a little bit earlier in my career, and I sure do not feel that way now with the tools we have and how we're using them. Alec, do you have anything to add as we wrap up here today?
No, I don't think so on the topic for today. So then looking into next week, do we want to stay on RILAs and then cover kind of the like income portion of these
Yeah,
things?
I think we can do wrap up next week, and then of course then we'll be in Dallas next week, and I think kind of post Dallas we'll have some fresh things to talk about, and I think we need to shift post Dallas into how are we communicating our mission? How are we using the tools, the books, whatever they launched this year? That what I'm saying, it's like how are we using these tools that the Wealth Wave platform provides to communicate to more people, get our message out there, and just guys, we're great once we get people in the door. We're elite at that. But how do we get more people in the door? I think that's where we got to shift our focus to, probably post Dallas. So, what do you guys think about that?
I like it. Yeah.
Yeah, I agree.
All right. Well, good to chat with you boys, and we'll be talking to y'all soon.